It starts with 4 small words: buy now, pay later. They appear at checkout like a whisper of permission. No interest, at least not at first. No credit check, or so they say. Just split your purchase into 4 easy payments and walk away with whatever you wanted. In 2021, Americans used Buy Now, Pay Later services, or BNPL, for over $24 billion in transactions. By 2023, that number had more than doubled. Companies like Klarna, Afterpay, Affirm, and Zip now process hundreds of millions of purchases a year. And almost everyone who uses them would tell you the same thing. It just feels easier than a credit card. That feeling isn't accidental. It is designed, precisely, algorithmically, and with extraordinary care, to feel that way. Because the BNPL industry doesn't make money when you pay on time. It makes money when the system it builds around you quietly, invisibly, engineers the conditions for debt. Let's start with what actually happens the moment you tap that button. In the time it takes you to blink, a BNPL algorithm runs what is called a soft credit assessment. It doesn't pull your full credit report the way a bank would. Instead, it ingests a different kind of data, and far more of it. Your device, your IP address, what time it is, how long you spent on the product page, whether you've used the service before, and crucially, whether you paid on time when you did, your email provider, whether you're shopping from a work network or a personal one. Some BNPL providers have been reported to use over 1,000 data signals in a single credit decision, all in under a second. The result is an approval rate that is strikingly, deliberately high. That's not a bug, it's the core of the business model. Because BNPL companies aren't primarily paid by you, the shopper, they're paid by the merchants. Every time a retailer integrates Klarna or Afterpay into their checkout, they pay a fee, typically between 2 and 8% of the transaction value, because studies show BNPL users spend more. They add more to their carts. They complete purchases they would have otherwise abandoned. The algorithm, then, is optimizing for 2 things simultaneously: approving as many purchases as possible to collect merchant fees, while also predicting, with high accuracy, which users are likely to pay late. Because late fees are the second revenue stream. When you miss a payment, the fee hits immediately. And unlike a credit card, where you might have a grace period, a phone call, a negotiation, BNPL platforms are largely automated. The fee is applied, the next installment still comes due, and the algorithm has already flagged your profile. This is where the engineering of debt begins in earnest. Here is something the BNPL industry does not advertise. There is no central system that can see all of your active BNPL plans at once. If you use Afterpay for a jacket, Klarna for a laptop, and Zip for a piece of furniture, all 3 companies are making independent credit decisions. None of them can see what the others have approved. There is no shared database, no consolidated picture of your BNPL obligations. This isn't an oversight. It's a structural feature of an industry that, for years, operated almost entirely outside the regulatory frameworks that govern traditional lenders. Banks must report to credit bureaus. Credit cards show up on your credit report. BNPL plans, in most cases until very recently, did not. This means a consumer could be simultaneously overextended across 4 or 5 BNPL platforms and appear on paper to have no debt at all. Researchers at the Consumer Financial Protection Bureau found that heavy BNPL users, those with 4 or more loans, were far more likely to be financially distressed than light users. They were more likely to carry high balances on credit cards, to overdraft their bank accounts, to struggle with other loan repayments. The BNPL plans didn't cause their distress in every case, but the system was clearly not designed to prevent it. It was designed to sell. Pay attention to how BNPL apps present your credit limit. It isn't framed as a liability, it's framed as a budget, a capacity, an invitation. You have $600 available, not you have $600 of potential debt available. Just available, like a gift. The language is deliberate. Behavioral economists call it pain of payment reduction. When you pay in installments, the psychological cost of the purchase is spread out and minimized. You're not spending $200, you're spending 4 payments of $50, and the first one isn't due for 2 weeks. By the time the 4th installment comes due, the dopamine hit of the purchase is long gone. The item is already in your home, already normalized. What remains is the bill, and the next sale, already appearing in your notifications. Regulators began paying attention around 2022. The Consumer Financial Protection Bureau opened an inquiry into 5 major BNPL providers, warning that the industry's rapid growth was outpacing consumer protections. The concerns were specific: inadequate dispute resolution, inconsistent data sharing, and a regulatory gray zone that allowed BNPL to operate without the disclosures required of traditional credit. In 2023, the CFPB issued guidance attempting to bring major BNPL lenders under the same framework as credit card providers, requiring them to investigate disputes, refund return purchases, and provide periodic billing statements. Some providers pushed back. Others, like Klarna and Affirm, had already begun reporting to credit bureaus voluntarily, partly to establish legitimacy, but also because positive payment history on BNPL plans could become a competitive feature for attracting consumers with thin credit files. Here's the painful irony. The move toward credit bureau reporting, designed to protect consumers, also creates a new risk. BNPL users who miss payments they may not have even known would be reported, are now facing hits to credit scores that affect their ability to rent apartments, qualify for car loans, or access traditional banking. The algorithm that approved them so easily has no obligation to warn them about the downstream consequences. None of this means BNPL is inherently predatory for every user. For someone who needs to spread a genuine, necessary expense over a few weeks with no other payment options, it can function exactly as advertised. But the system is not designed with your financial health as its primary variable. You are a data point in an optimization function that balances merchant acquisition, approval rate, and late fee generation. Know the total amount you owe across all platforms, not just the next installment. Treat the limit they give you not as permission, but as a ceiling on how much you could owe simultaneously. And ask yourself, before you click, if this item were full price, would you still buy it? Because the algorithm already knows the answer to that question. It calculated the odds before you finished loading the page. The 4 words are still there: waiting, buy now, pay later. The question is, who exactly is doing the paying?